I guess it would help if I pulled my mic down. There we go. Hey guys, can everybody hear us? Testing. 1, 2, 3. Testing. 1, 2, 3. How's everybody doing?
Fantastic.
All right.
Yeah, great.
Kev, we good?
Yeah, audio had a little.
Okay. We're dialing in the audio, guys. Let us know how it sounds. Cool. Well. Welcome. Today is September 1st.
Oh, yeah, I forgot. Brand new month.
Brand new month. 2021 is flying by. Still feels like 2020.
And we're almost to 2022.
Yeah. Oh my God. How are you guys doing out there? Welcome, welcome. Let's go ahead and kick this thing off. Actually, I think we're going to try to do, obviously, kind of similar to how we've done before, where we talk about some news and some charts, but we also want to dive into, I guess, what our best strategies have been over the past year, and maybe what we want to be doing over the next year, or where we see opportunity. What do you guys think?
Yeah, it doesn't even have to be the last year, just over the last decade.
Yeah. I mean, the last year we've had some really big plays, and I think there's a lot of lessons we can learn and teach from that. But
yeah,
and there's also, I don't know, there's some changes, there's some new stuff I'm looking at. I know you guys are.
Yeah, you got to constantly be evolving with markets. Markets are constantly evolving. Strategies are evolving. Your competition is evolving in the markets.
That's true.
So
how do you beat the competition?
Well, if your competition is James Simons at Renaissance Technologies, good luck. Because you will not beat them.
Yes.
But,
if your competition is NFT traders, you probably got a shot.
yeah, exactly.
Cool.
But, yeah, we've got some thoughts on that for sure.
Yeah. All right. Well, let's go ahead and jump into, I guess, let's get grounded in the markets and just talk about where we are. Really no change in price for Bitcoin since last week. We're still hovering around that 50K zone. But one thing that has changed since last week is we've got decorrelation. Yay!
Hey, that's always exciting.
What does that mean? Well, we're starting to see some altcoins pop off, even though Bitcoin is just chilling.
Yeah.
So
we've got relative strength.
Yep. We've got ETH up 10% today after having the start of a breakout yesterday. Today was really kind of the bigger breakout candle. And there's a whole lot up. So if we just look at, kind of over the last 24 hours, some of the largest markets were up about 5% across the board. Up about 5% on the month, up about 5% on the week, 40% on the month, and 750% across the year. And that's kind of like the main US tradable assets. This isn't all cryptocurrencies. Excuse me, but it's a lot of the ones I look at. And then I don't know what's going on in stocks, guys. Looks like the S&P just is keep on trucking higher along with the NASDAQ. What's happening over in stock world?
Nothing's really changed, since last week. We made new all-time highs again, and we kind of are starting to see a little bit of a slowdown. Maybe we pull back from here, but who knows? It's too hard to predict from at this point. It's like when we think we're going to see weakness, it just reverses and blows through all-time highs.
Yeah, I mean, when the stock indices are in this just like straight up, hardly any pullbacks, it's like picking a top there is really dangerous because it can just keep going and going and going.
I will say this. I did a dive into my portfolio recently, and I'm thinking about harvesting more cash and maybe pulling some passive money and getting it into cash for active investing because, when the market has had quite a run and, there are still risks out there. And if we do finally see this market tire out, I want to be ready because I think that there's going to be opportunities coming.
So you're going to start selling some stuff to have
a little bit of passive money. I think I'm going to be selling it to get a little bit more of a cash cushion in my active portfolio.
What of your portfolio? How much is passive versus active percentage-wise?
Right now, I think I'm 30% active, 60% passive. Okay. So the bulk of it is passive, but
so 2/3 passive, and you want to make more of that active.
I think I want to move a little bit more into active. Yeah,
cool.
As we're moving in all-time highs, feels like a good time to do it.
To be strategic.
Yeah. In
the event of pullbacks.
Yeah.
Cool, Trav. What are you thinking?
Yeah, I like that plan. I've been slowly trying to consolidate my portfolio. Got to a point where I felt like I had maybe too many stocks in the portfolio, was making a few more mistakes, not being as focused on the research and as concentrated in the positions that I wanted to be concentrated in some cases. So did start to sell a few positions that were non-core a couple weeks ago. Still looking hard at what I might trim. Still have the hedges on. So I guess similarly, really just taking less broad market risk and a little bit more of specific idiosyncratic risk on the handful of stocks that I really like that I think are still very underpriced.
Yeah.
So that's kind of my strategy right now. I don't have a strong view on the broad market one way or the other, to be honest, at this point in time. But I do think, like, from a risk reward perspective, it probably is, less skewed to the upside given where we're at, as you can see.
Yeah.
Yeah.
Makes sense. On the crypto side, I mean, things are just starting to pick up momentum again after having some really deep pullbacks. There was a lot of cryptos that were down 70, 80, 90%, and some of those are already back, like testing all-time highs. Like, here's a ticker that we bought down around, what was it, like $9 or $10? Atom, Cosmos, ATOM is the ticker. And then I've just got, I think, a quarter or a third of this left on the table. But here you can see, I mean, it's back at all-time highs after having a 75% drawdown. So this is pretty common in crypto. You get this kind of crazy volatility. And if we look at basically the non-Bitcoin crypto market cap, you can see, I mean, it's not that far off of all-time highs. So, I know last week and the week before that, we talked about the potential for kind of a round 2 altcoin season in 2021. If it's going to pop off, I think this is kind of where it pops off from. And we're starting to see a lot of that kind of popcorn effect with different tickers starting to either rip new all-time highs or rebound from the deep pullbacks. And yeah, I don't know. It just feels like, with the NFT craze and with so much excitement around this newest wave of DeFi, it doesn't seem like the markets are done yet.
Is this the start of the flippening?
Who knows? I mean, actually, I laugh, but let's just look at the Eth BTC chart. So if we look at kind of a weekly chart, you can see that ETH compared to Bitcoin's value is challenging a major breakout level here. So, if Bitcoin consolidates or kind of grinds sideways here and ETH breaks this level, I mean, we could see a parabolic move in ETH where, maybe we get above 5, 6, 7K. So we'll see what happens. Mm-hmm. But outside of the charts, and I know we're going to get to some questions, I wanted to pull up something that I thought was beautiful. And I think this is probably one of the quotes of the year here.
I can't wait.
I don't know if you guys have heard of this, I guess, a group of people. It's called the IMF, the International Monetary Fund. They do fiat shit. Doesn't really matter. But they had an article here, and I just thought it was funny. One of their quotes was, "And yet, Bitcoin lives on."
Oh, yes.
I think this is just, this is something that's so sweet because, you've got all these attacks. We've had hundreds, if not thousands, of Bitcoin obituaries over the years. And yet, Bitcoin lives on.
Snaps for Bitcoin.
Yeah.
It's made it. You guys made it.
It's awesome. And we've got, let me see if I can pull up the article here. I don't know where I put it.
I think I gave my thoughts on the IMF a few shows ago. If y'all want to just roll that tape back, I won't repeat it here. There was some strong language. There was some strong language used about the IMF.
Yeah,
I think maybe about 2 months ago.
Yep. Yeah, that's true. I mean, you're not a fan. Why are you not a fan of the IMF, Trav?
I don't really care about the IMF. I think they're kind of useless, to be honest. And I think in the past they've probably done a lot more harm than good when it comes to a lot of emerging economies and the lending that they've done and the strings attached. And I just think that the world can do better than the IMF.
Yeah.
So.
Awesome. And yet Bitcoin lives on.
That's right.
And then here's an article. Was it today or yesterday? Paulson basically came out and was calling crypto worthless. And, just shitting on a lot of the NFT stuff and DAOs and things like that. But the important thing to keep in mind here is, and yet Bitcoin lives on.
John Paulson had some great trades in 2007 and 2008, and since then he's been irrelevant in stocks. I'll tell you that. He has been irrelevant as a hedge fund manager for the past decade. So, look, I think he's probably a smart guy. He's probably got a smart team, but his funds haven't done very well, and he's kind of a one-hit wonder.
Yeah.
He nailed the housing crash of 08. That's about it. I'm kind of waiting to see if Paulson is going to ever do anything worthwhile again.
Yeah.
Yeah.
I mean, some of those macro guys, they get one big trade, they get rich, and people think they're geniuses, but it is like a situational thing, right? They got lucky once, and then they kind of fade into the background, and then every now and then they say something dumb like this.
Yeah.
I mean, it's about adapting. Like, there are a lot of these guys that have been coming from the old school. They have a hard time adapting to these new technologies and these new ideas. You know, most people from the old school thinking of investing in finance think NFTs are dumb. They think that crypto, it's not backed by anything, therefore it's worthless. You know, they think all of these things that we know there's a whole different economy emerging.
Yeah, they parrot the arguments that became outdated in 2013.
Yeah, they just can't get past it and evolve.
Yeah.
And look, they're richer than us.
Yeah, they are. They are, absolutely.
But
we're coming for them.
Yeah, exactly.
But
and
you know, don't crap on it if it's helping people build a ton of wealth. There's obviously something there potentially to think about.
Yeah.
And
well, look, Paulson, if you're watching this, which I'm sure you are, I'm sure he's watching right now, I just want you to know something. And yet, Bitcoin lives on.
Hey.
So you can talk whatever shit you want.
Cheers to that.
Here's Waterloo.
Need whiskey for that toast.
Yeah. All right, cool. Let's get into kind of the core topic of today, which is our favorite wealth building strategies. Let's talk about where we've been and where we think we're going. And I wanted to kick this off with something that I tweeted last week that I just think is really, really important for new folks to think about. And I said, you know, I don't know who needs to hear this, but the first goal in trading and investing is survival. No matter how much conviction you have on an opportunity, don't do anything that's going to permanently take you out of the game if your thesis doesn't pan out. Learn to survive and then thrive. I think it's important to start with this because this is where a lot of my investment plays actually start. Is like, I don't want to do anything that's going to cause a permanent loss of capital, even if I think I can make a shit ton of money, right? And that's why I've avoided, excuse me, some of the higher risk, higher reward kind of like yield farming, lending stuff, or some of these altcoins that have like a cult leader and they own or they control most of the supply, or there's admin key risk. Like, whenever I look at something, I think about what are the probabilities that this goes to zero and I lose that capital permanently. I don't care if I can 1 million X capital if there's a 50% chance that it goes to zero, right? Like that, for me, that's where I start. I've never blown out an account. I've had deep drawdowns and I've had significant losses, but I've never been destitute and I've never like blown out an account where I'm like, oh my God, I'm never going to financially recover from this. And that's the reason why is no matter what I'm doing, it always starts there. So what do you guys think? Is that too conservative? Am I leaving money on the table? Do you guys have a different way of thinking? What do you think?
I'm with you. I have the same approach. I feel like I'm happy with where I've come from and what I've built, but I feel like I could have done it a lot quicker if I had a higher risk tolerance. But I've never blown out an account, and I sleep well at night.
Yeah.
And I'm never worried that one position is going to completely ruin me. And that's how I've approached it, and I'm comfortable with that. So, yes, like there are positions I feel like I could have definitely gone heavier on and taken more risk with, but I just can't do it, you know? And that's something that I feel like I'm starting to consider that more and more. Like right now I'm doing a lot of research, as you know, on Pinterest, and I'm thinking, you know this too, like thinking, you know, is there something here that I could really build into and make this, you know, a very large position in my portfolio potentially. And you got to do a lot of research to figure that out. But I'm thinking that way. Like, I don't want to be too small. I don't want to not have a big enough piece of the pie. And then I go back to my roots and I'm like, wait a minute, like, I'm still not comfortable doing that. Like these people that take these very large positions, 30%, 40% in crypto. I don't know how they do it. I don't know.
30 or 40%
That's
position
probably
sizes
low.
in crypto
That's
is
low.
actually fairly low. Like some people just YOLO in, and if they're not 100%, they're overextended
Yeah.
in a single position. But yeah, I think that makes sense. Trav, what about you?
What if I told you you could have your cake and eat it too?
Ooh,
Tell me.
here
Give
we
it
go.
to me. What you got?
Well, okay. So I'm very much agree with you all. I do think it is fun to give yourself the opportunity to swing big.
Okay.
Like you can get rich slowly while also taking some big fat swings. That's kind of what I try to do. And the goal or the idea is to be able to stay in the game. Like you said, that's goal number one. Don't take yourself out. Don't get to a certain wealth level and then lose it all, right? Because psychologically, that's how a lot of people end up in the darkest pits of despair in their lives, you know? You don't ever want to get to a certain stature in life and then go backwards.
Yeah.
Right?
And we've seen a lot of people do that, right?
Yeah.
Where they build position sizes, then they get too aggressive, and then they blow up, and next thing you know, they're out,
Yeah.
right?
Yeah, and you know, you look at like compounding math. We've talked about compounding. If you've never looked at compounding in a spreadsheet, go look at compounding in a spreadsheet. I could even provide you one to show you what it looks like. But your money grows non-linearly, right? So if you compound at 15 or 20% a year, oh, it sounds fine. Make 15%, make 20%. Sounds fine, but not great. Well, you know what? In 10 or 20 years, compounding at 20% a year actually ends up giving you like multiples, like more than like 10x your money, right? And so that is something that a lot of newer investors don't internalize. So you can get really, really rich slowly. Like Warren Buffett, for instance, he's one of the richest men in the world. He wasn't a billionaire until he was like in his, I think, mid 50s or late 50s. He made the bulk of his money from the age of 55 to 85. So like, you know, if you want to get really, really rich, you don't have to try to like bet everything on one high risk bet, right?
Yeah.
You can compound your capital over time and it will grow non-linearly if you're compounding, right? And then on top of that, you can take a little portion of your capital, especially once you get to a certain level, right? Where you've had all your basic needs met. And you can take small portions of your capital and YOLO it in, right?
Yeah.
You can YOLO into the GMEs. You can YOLO into the AMCs. You can YOLO into some shit crypto, right? Like,
That's kind of where I feel like I'm at. I feel like I'm to the point where I've, you know, built up to a certain level that I can afford to take a larger position,
Yeah.
take that big fat pitch on something. And it's just mentally allowing myself to do it
Right.
at this point.
Well, and it's got to be the right play, right?
Right.
Like that's how you have massive gains on a single play is you size them big and you're fucking right. You know, you got to be right. And like, and you know, we talk about, you know, you were just saying 15, 20% a year, you can get really rich. And in crypto, I know we're spoiled because we've had, you know, call it 200% annualized average returns on Bitcoin over the past decade. Like,
yes, y'all are spoiled.
yeah, we're spoiled and we've made a lot of money in a relatively short period of time, right? And we've seen gains that are like sped up, like what would take somebody a lifetime to earn. We've made life-changing gains sometimes in a single year, right? But when you expect that to happen every year, in perpetuity, that's when you start swinging and you're like, oh shit, I just lost 80% of my capital or something, right? But I mean, Bitcoin was one of those plays for me where it wasn't anywhere close to 100% of my portfolio, but it was in 2013, 30 something percent of my net worth in Bitcoin. So that to me was super high risk because it was after the first bubble. It could have gone to zero. I could have lost a third of my net worth, but I would have still been in the game, right? I didn't have to go 100% to make life-changing gains. You can still manage risk and get rich.
yeah.
Right?
Yeah.
Yeah.
Yeah, and I think that it's like next level time for me. That's
Yeah?
what I'm realizing. So we'll see what happens.
Step it
But,
up.
yeah, I think that's good advice, Trav. I'm glad that we brought that up.
Certain asymmetric bets are better than others too, right? Like if you can find 10x potential investments where you don't risk a lot to make a lot, And those are, you know, they're harder to find, but I think those are, if you're going to, you know, take kind of big swings where it's not like a certain bet and you're looking for a really high payoff, try to find the ones where it's like, okay, if I'm wrong, I lose a little. If I'm right, this could be massive upside.
Yeah.
That's what I'm always trying to look for, is those kinds of opportunities. And the reality is some of them aren't going to pan out. Like, you know, I had a gold spread on that was like a 5x type of upside. It's going to expire this month worthless. But I sized it at like, you know, less than 1%. So it's like, okay, that's a bummer.
Yeah.
I risked 1% to make 5%, and this one's not going to work out. But, you know, there's other situations where I've hit 20x, 30x payouts on those kinds of bets. And so those are also ways to kind of get there as well, if you're going to, like, if you have part of your portfolio, you're trying to get that like really massive return.
What's an example of a play that you did that where you sized it big and it did pay off?
Good question. So I've had a number in the, like, in the options world where I've done like I did an options bet, I think last year, on a mall REIT, Taubman, that was being acquired by Simon. And the deal broke, and I had some puts on Taubman because I figured the deal was going to break. And that was about a 20x, but it was very, very small position size. That was a 20x. That was a pretty solid example. What else recently? Let's see. I've had, you know, I have some SPAC bets on right now that I think have the potential to be like 5 to 10x, or maybe even more in some cases. Low probability that they actually pay off at a 10 to 100x, but there is that potential, and they're sized relatively small. And those, I actually have a SPAC bet. There are people in the community that know about one of them where there's essentially zero downside and there's only upside. And
How does that work though? Because that's not common.
yeah.
And it's like, you know, you've almost got to be careful when you say there's an investment that has no downside. Like, there's always some risk there, right?
Yeah. Yeah, there's theoretically zero downside, but in reality, probably there's still some amount of downside. But basically, I've identified a trade where it's an in-the-money call option on a pre-deal SPAC where, because of the SPAC arbitrage, like if this SPAC never does a deal, or if it does a deal that the market doesn't like, then investors can take their SPAC shares and give them back to the company, and they get cash. They get like around $10 in share cash back, right?
Yeah.
So there's this arbitrage in pre-deal SPACs, right? So a SPAC never really falls below like $9.65.
Until a deal is inked, and then it can fail.
That's right.
But
once the deal is completed and after the redemption phase, then it becomes the final SPAC company, and it can trade to whatever price.
yeah,
But during the deal phase, or during the pre-deal phase, the lowest you'll ever see a SPAC stock drop is to like $9.65. And eventually, once it gets to the redemption phase, it should trade around $10. Even if investors don't like the deal, they redeem their shares for $10 in cash.
yeah,
So what that means is, if you're buying a deep in the money option, let's say a 5-strike call or a 750 strike call, and your break even point, you buy the option at a price where your break even is below $10, you don't really have a lot of theoretical downside.
makes sense.
Now, where's the upside? So then the question is, well, how much could I make? Well, some SPACs like DraftKings, or what's a recent one that's gone, Skin. Yeah. Those actually do good deals that the market likes.
Oh God.
And if you bought a 750 strike call for $2.50 or below,
Yeah,
then that is now worth, well, I guess in the case of Skin today, it'd probably be worth about $15 to $20. So you made about, what is that, 7x or so? And so,
Nikki, you're crying over there. Is this one that got away?
Yeah, I wish you didn't bring this up.
Twist the
I'm
knife.
just kidding. Continue.
yeah, so basically that's it. I mean, your upside is a multiple of your initial capital, and your downside is theoretically near zero if you're buying the in the money call at the right price.
Yeah,
That's a pretty good trade.
yeah,
Now, 9 out of 10 of those won't pay off. You'll just end up breaking even. The SPAC will trade at 10, and it'll trade at 10 after the deal, and your $250 call that you bought will just still trade at 250. Fine, whatever.
Yeah.
That's fine. Sell it for break even. But if you get this guy, then
It's an option of a good deal happening.
Yeah.
Essentially.
I love what SPACs are doing because it introduces, like you said, like a new asymmetric way to play these things. And the way that I look at it to kind of compare this to crypto, which we don't have this exact like tokenomic situation where you have like a $10 NAV price and then like, you know, usually what happens though is if you have a good project with solid fundamentals and good tokenomics, you'll see these accumulation ranges where, you know, it's like either at ICO price or below ICO price. And there's never a guarantee that a crypto is going to hit a bull cycle. But when you're at those like really low accumulation ranges and then you get that first breakout, your risk to reward is really insane in a lot of cases. Like we see 5, 10, 20x, 20 to 1 plus ranges that happen. And they're always impossible to know how far the trends are going to go. I've way underestimated some. I've overestimated many, but like, you know, how many cryptos have we seen that have gone from a few cents or a few bucks into the hundreds or thousands, right? Like I remember thinking that Bitcoin at $100 and something was just mind blowing, right? Never did I knew the extreme bull case was tens of thousands or hundreds of thousands of dollars, but to think that it would happen so quickly, right? You never want to underestimate what crypto can do. And so for me, you know, talking about like our favorite wealth building strategies, one of mine is hunting for those coins that are in that accumulation range before the big trend starts to kick in. You can trade on the way up, but if you have a core position at those pre-pump prices, it's like, my God, man, the risk to reward is just insane. And then you can ride that trend without worrying, you know, about every little pullback. But if you're chasing the hype and you're buying high, you're going to be a hell of a lot more nervous during every pullback. So that's how I kind of think about that. Trying to find those like 10xers or 100.
Are these usually technical only trades for you, or are you using some type of fundamentals of the coin?
The fundamentals absolutely matter. And when it comes to the coin, it's the tokenomics, right? What's the supply? First and foremost, what is the project? Does it even need to exist, right? And that's a big point of contention. You have Bitcoin maxis that say everything that's not Bitcoin is a scam. You know, you have a lot of tribal-minded stuff that happens. But for me, what I really look for and what I acknowledge is like, I don't know which of these projects are going to win 5, 10 years from now, or which ones are even going to survive. But I look for, you know, a solid team. I look for good tokenomics. So there might be like a cult leader, but if that leader of the project controls most of the supply and the liquidity is really low, I'm going to avoid that. Or if there's some kind of sketchy pre-mine, like there's a handful of red flags that you can look at in the fundamentals of a coin. And I've passed. I've had JOMO. I've had the joy of missing out on a lot of projects.
Like Doge, for instance, right?
Yeah. I mean, look, Rocky Crypto Hustle, he traded Doge up and made a ton of money on that. I just avoided it.
Yeah.
You know, and I realized I don't have to catch every project or every move to make a lot of money, because again, going back to my first rule, I want to avoid permanent loss. I don't want to get rug pulled. You know, I know some guys that have made good money in yield farming and that stuff, but they've had significant losses, in some cases tens of millions of dollars in losses that they're not going to get that capital back, so they have to trade that back or earn it through these high yield things, hopefully, right?
Yeah.
So everybody's risk tolerance is different, but with where I start is I want to try to avoid, I'm not always going to avoid it, but I want to try to avoid permanent loss.
So do you notice that it seems like you're very selective with what you choose? Is that, are you kind of like the unique situation in the crypto space? Are a lot of crypto traders or investors just trying to grab everything and kind of over trading in a way?
Yeah. And
Because
that's why
the excitement of it all.
And that's why so many people lose money in this space. And that's why I wrote the book back in 2015. That's why we do what we do, right? Is to help these people not blow up. Because I've got the thousands of emails over the past decade of people doing that. And I'm like, let me see if I can help somebody not do that.
I mean, it's similar in stocks, right? I mean, there are thousands and thousands of stocks teasing you every day. And I think that this is something that Travis and I are both trying to focus on. Travis, I know you're focusing on, you know, consolidating your portfolio, doing more deep diving work into a select number of tickers versus being, trying to be spread too thin. And I totally see the value in that. I'm as well. For a moment there, it was kind of like squirrel. I was all over the place. There's so many tickers, so many things, but I'm starting to, I'm starting to do more work on less tickers and really hone in and build meaningful positions, or at least this is my plan. This is what I want to do. And it's hard to get to that mindset because you don't want to miss out. It's that fear of missing out is so real for people. But really, the more you're in this game, the more you realize that just waiting and doing the work on the ones that seem the most promising is usually the better play.
It's sort of like that old headline from the 2017, 18 crypto top. Everyone's getting richer than you.
Everyone's getting hilariously rich
well,
except
yeah.
for you. Yeah.
Yeah.
And yeah, there's that FOMO. It's real. It's totally real in stocks, crypto, whatever market you're in. It's real when you see other people that are crushing it in a short-term environment, especially when the environment's hot like we had in stocks at the beginning of the year or whatever. It's like everything's popping off. There's something new every day.
Yep.
Even now with the meme stocks, like it seems like people are rotating to a different meme stock every other day.
Yeah.
And hunting the next big meme pop.
And I don't have time for that anymore. Like I see it. I've seen all the different tickers. They pop. You know exactly what's gonna happen. They're gonna pop and then they're gonna fade.
Drop,
They're gonna drop, pop and drop. Like
Pop and flop.
like
Pop and
the
flop.
rap song.
Yeah.
No, and like I'm like over that at this point in my life. I'm like, no, let me find something quality and research it and really focus on that.
So are you going from, I guess, more of a shorter term trader, like swing trader, to you're looking for multi-month or multi-year position?
I mean, I've
holds,
already
or-
made that transition essentially from like day trader, into swing trader into an investor.
Yeah.
I still, like the idea. Like right now, I'm watching AMC. Like, look, you can turn the trader into an investor, but like you can't take the trader out of the girl. Like,
Yeah.
it's in there, And so like I've been watching the chart, maybe there's some type of momentum opportunity here that I could take advantage of via options or swing trading it, something like that. Like I'm not against trading and I'm still looking, and if an A++ trade comes along, I'm probably going to be tempted and I'm probably going to take it, right?
Yeah.
But I definitely am more focused now on really building that long-term portfolio with, I've had some really good plays in things like Square and Lululemon and, a few other names that have been things that I really did work on, and it paid off. And I want those types of opportunities,
Yeah.
That's what I'm looking for now.
Bigger gains on less plays.
Yeah, like let me think about where this business is truly going to be in the next 10 years, and like what is the market going to get excited about with this business?
Yeah.
What moves could this business make that the market isn't maybe seeing right now or isn't appreciating right now? Like these are the types of things now I'm taking to these different names and researching.
Makes sense. Trav, I know you've been doing some deep dives on stuff.
Yeah, I've got some stuff in the works that I think could be pretty interesting, and let's just leave it at that.
Okay.
Well, I'll have more to say on that later, but I agree with you. I think, especially once you taste like that 10x type of
That
return.
10x is a
and we're not talking about overnight. We're talking about like a Square,
a few
Lulu,
years,
yeah, those 10x's are nice, and it's so nice too that where you can take days off. If you identify some really compelling opportunities and you buy them for a longer term time frame, it's so much nicer to get rich that way than it is to have to be glued to your screen every single day, picking a new stock every day, trying to catch every little move on a daily basis.
Yeah.
Absolutely. Absolutely.
Like you can make good money doing that, but you got to be dialed in all the time. You got to be constantly evolving your strategy. You got to be, very focused.
This is why I love fundamental investing so much, and this is coming from being a technical trader, right? I love it because it just helps you stay in. It helps you stay the course so much better than just technicals alone.
Yeah.
So I'm really enjoying that part. I have Travis to thank for getting me involved in fundamental analysis, but it really takes a lot of that that mental stuff that happens when you're in something. It helps take it away.
Right. Well, does it give you more conviction?
More conviction, more confidence, and you don't get distracted by the noise in the price movement, or the noise in the earnings report, or the noise from how the market is interpreting something. You know, you have your own thesis, your own theory, and you use that to stay the course.
Yeah. I mean, it's the same in crypto. You know, one of my biggest trades over the past year has been Ethereum, where, let me pull up the chart here. So, you know, this is one where it was a technical, fundamental, and market sentiment play, right? Those are like the three horsemen. I'm going to just pull up like a weekly chart. And so we started buying here in like the 350 zone, added on the 1400 break, and then took advantage of the parabolic move up to 4K, right? And then I'm still holding a large position here, but what, you know, if you look at this is like October of last year. I wasn't taking profit until May. So what is that? You know, October, November, December, January, February, March, April, you know, over 6 months, 6, 7, 8 months, right? And I'm still holding a large position in this. So my average hold time in crypto went from like in, what was it, 2013 and 2014. You know, I was still learning and trying to figure the crypto game out, but my average hold time on a trade was like 2 weeks, you know, maybe a few days to a few weeks. Now it's several months. And I've noticed my gains have gotten bigger as my trading frequency has gone down. So making more, doing less. Now, could I do more yield farming and squeeze more alpha out somewhere in there? Probably. But again, if I look at a project and I'm like, there's admin key risk, or there's cult following risk, or there's some weird fundamental shit, I'm just going to avoid it.
Is there something that would happen to make you more convinced on the yield farming stuff? I'm getting asked this a lot about yield farming.
Yeah, look, I'm not against it. I just, when I look at the opportunities that are out there, I'm not willing to take the risk for the reward that I see, right? Some of the biggest gains have come before the biggest rug pulls and drops. And so people think they're making a shit ton of money.
Well, they are,
and
right?
they are, and then they
Some
get
of
rugged,
them.
and then it's like, oh, my capital is no longer gone, let alone those paper gains.
Yeah.
Right. So, there, you know, and we've already seen like yield compression on BlockFi and stuff like that. Like, you know, yields are coming down.
That's
You're not
bound
gonna,
to happen.
Yeah.
Yeah.
You know, so I looked at that and I'm like, I don't need to FOMO into that. I don't need to FOMO into NFTs. Like, you know, people are making good money on that, but also was talking to a guy the other day, lost over 90% of his money on NFTs. So, you know, you've just got to know the risk for the reward that you're seeking. And, you know, somebody might be listening to this going, man, I made a ton of money yield farming and I just sold an NFT the other day. Congratulations. There's no right or wrong way to do this. Everybody has, it's like a choose your own adventure, but you just have to know if you're playing in this field over here, what the risk is. And are you willing to lose 50% of your capital overnight? If not, stay away from some of those things.
I can't help but wonder if people realize the amount of risk that you take on with doing yield farming and NFT stuff. Like right now, all you're hearing is the media saying so and so made $1 million selling an NFT, or so, you know, that's all you're seeing is, oh my God, I need to get into NFTs. People are getting crazy rich on NFTs.
Yeah,
you know,
we know how this ends.
Or you're seeing, oh, people are making buku bucks yield farming and all of this, but like, do these people that are getting into this actually realize the potential 50 to 90% loss, or the hack, or you know, whatever risks that are out there? I mean, this is high risk stuff. Yeah. At least coming from like a financial planning perspective.
Yeah. Well, even coming from the crypto world, like, I think some people just don't care. There's like in the NFT space, I see there's like ego attached to it, and people just want to, you know, they want to flex. Like, dude, look at my rock, or look at my my lazy ape, you know. So yeah, I don't know. Everybody's got different goals. Obviously, this show is about like growing wealth and like being disciplined, and you know, that's why we're not getting millions of views because it's not hot and sexy, and it's not that world, right? We're not the YouTube cover images with like
We're the tax of market podcasts.
yeah, and I'm fine with that, because we're gonna help people not blow up.
I think NFTs are really fascinating right now. Obviously, the market is just in fuego. It's like insanely hot. Even just in the last 2 weeks, I've seen more and more Twitter posts about insane prices on NFTs. And I don't think NFTs are a bad thing. We've talked about being bullish on NFTs like in a broader sense, especially in certain areas. And I don't think it's necessarily a bad thing that there are people that are dipping their toes in NFTs. Where I think maybe what we're trying to say is that if you're doing something where you're putting all your capital, let's say, into an NFT because the space is hot, that's where you start to run into like a problem where you're like, are you willing to lose 90 to 100% of your capital? Because there will be a washout in the NFT space.
Yeah.
All these NFTs that are selling for $100,000, $500,000, $1 million, whatever, that's awesome and great. But that will probably not last because there's going to be a lot of supply being brought online. The euphoria phase will fade, as it always does in every asset class. So I think what maybe we're trying to say is like, we're not like anti-NFTs. What we're saying is like, listen, be thoughtful about how you allocate your assets. If you are 90 to 100% in anything, whether it's NFTs or stocks or crypto, you need to take a hard look at that and think about whether or not that's prudent. I don't think that personally is very prudent. And you have the potential there to lose everything or most of everything. So that's where I think, I think that's ultimately what we're trying to say. Yeah. It's like, think about it from a portfolio approach. Think about getting rich slowly over time. If you want to spend some of your capital in NFTs, absolutely do it. You might get 100x on it, and it might end up being bigger than the rest of your portfolio, and that's awesome. But if you're in an NFT with 100% of your capital and you're just YOLOing and praying that it's going to work, that might be a recipe for unhappiness down the line.
Yeah, there's a comment that just came in. Mike said, NFTs like Axie will allow you to cycle capital on a weekly basis. So some of the risk is mitigated from being able so basically having some consistency there. And like, that's good. Like if you're thinking about the fundamentals, like that's great. Think about like, what is the worst case scenario? Like, how could I lose all this? Like, how could this break? And if you don't see a high probability of permanent loss there, that might be a quote unquote safer bet, right? But always think of the downside and the risks first. Don't just get mesmerized by the potential reward. That's how people really get rugged.
If you were going to buy an NFT, which would you buy? I've thought about this. I've thought about like, should I buy an NFT?
In-game assets.
In-game assets.
We've talked about AXS over the past few weeks.
Okay.
So AXS, I mean, this is one that basically went from a few bucks up to 80 something bucks a couple weeks ago, so when you have economies like this, and this is just one example, right? But I am much more bullish on gaming and digital worlds than I am JPEGs.
Same.
Yeah. I mean, that's just my thesis at like a high level. I'm not as cool. I don't have any of the JPEGs on my Twitter. I'm fine with that. I want the in-game stuff. People that are going to actively be using the NFTs.
Did you guys see the news about China trying to keep children from gaming too much? Do you guys have any thoughts on that?
Yeah, it's dystopian and it's stupid. Okay. Yeah, what is it? It's like they can only play like a couple hours a week.
3 hours, I think. They want to limit it to 3 hours. 3 hours a day or 3 hours a week? I can't recall, but it's one of those.
How do you control that?
Well, in China's case, you basically put it on the game providers and use like Tencent.
Okay,
and you say, all right, Tencent, you put app controls in, you put literally a time limit, like kind of like you can do with your phone where you set limits for like social media or whatever, where it won't open the app if you've been in it a certain amount of time.
I heard you actually have to verify your identity too when you're like working through their gaming platforms. So like they know who you are. Like surveillance state is real. Also, I guess this is a good time to bring this up. Australia is pushing through a bill that is like China level dystopian shit. This has been going around social media over the past day. Absolutely crazy what this allows police to do. Australian police can now hack your device, collect or delete your data, take over your social media accounts, all without a judge's warrant. There was also a video I saw a couple days ago where a police officer was at somebody's door and they were filming through their window. And the police officer was like, are you or anyone else you know planning on attending a protest in the future? Not, did you go to a protest? Have you committed a crime? But are you planning on doing this in the future? And the bravado and just the cockiness of this cop was terrifyingly disgusting because, I mean, they just feel so emboldened to, I mean, they I don't know, man. It's looking dark over there. Let's say that.
Yeah, I think there's going to be a push-pull with the surveillance state for the rest of our lives, to be honest. This is not going away. This is, certain countries like China will have, more power than others. But I think this is a fight that we're going to be fighting for the rest of our lives.
Yeah.
It's all technology's fault. I mean, we can go back to rotary phones and we can go back to flip phones and, we could do that.
Yeah.
Phone books.
Yeah, man.
MapQuest.
What's the saying? Don't waste a good disaster.
Yeah, don't waste a good crisis. Yeah. Yeah, there's always crap.
COVID has given governments excuses, to save people, right? What are the two most common ones? Child abuse and terrorism, right? And we're seeing that with Apple's new dystopian spyware that they're going to be rolling out, and what Australia's doing, and yeah.
So here's an interesting thought experiment. One of the more interesting applications of blockchain is to have like a publicly decentralized tracking of whether it's property rights or your votes in an election, right? Things like that. I think those are really fascinating applications, but in some sense, they actually could add to the surveillance state or could add to the ability for others to track your political beliefs or your movements or your capital, right? Mm-hmm. I mean, how do you square those two things? If you're a crypto libertarian, how do you square a massive potential of these blockchain applications with this idea that maybe that makes you more trackable across society?
That's a great point. I mean, I think it's like any other technology, right? Where it's not good or bad, it's how people use it. And we can see cases where people can use it for good and bring light to supply chains and, like you said, property rights where governments have just stolen property from people in the past. But yeah, I mean, that's basically what China's doing with their fake digital currency is, they want to track and control your yuan, and they're going to be like, hey, listen, you said something against Xi, you called him Pooh Bear or whatever, and we're going to drain your wallet and you're going to live in poverty now. It's terrifying. So there's going to be real blockchain and there's going to be fake blockchain, but even real blockchain could potentially be used for evil.
Yeah.
So
Interesting.
do we stop technology? Stop?
Yeah, I mean, what do we do? Do we just go back to the Stone Age? No.
No, yeah, like, do we just accept this new paradigm that's probably going to happen all over the place?
Yeah.
Privacy gone?
I mean, people need to push back. I think people are waking up to the need for privacy, after like the T-Mobile hack, right? 40 million people's data exposed, SIM swapping all the time in the crypto space, and it's bleeding out into other spaces. Apple, people that are a company that was supposed to really give a shit about privacy is now like, no, you know what? We're going to scan your photos. And that's really just the start of it. So people have to really learn how they can take control of their data and be proactive in protecting it.
Fair. Yeah.
All right. Man, that was kind of a heavy conversation. Moving on, let's go even heavier, shall we? I've been saying this, talking about investing strategies and a thesis. I am really bullish on real estate where there's a lot of water, a lot of rain, and a lot of fresh water.
Yeah.
I thought this article was really interesting. Redfin, I guess, did this study. They found that more people are moving to areas that are facing higher risk from climate change. So counties with the largest share of homes facing heat, drought, fire, flood, and storm risk saw their populations grow over the past 5 years due to migration, where counties with the smallest share of homes facing climate risk saw their populations decline. So people are moving from low-risk areas to high-risk areas.
Well,
I think that trend is going to reverse, and I am super bullish on certain areas in the U.S. that are not at risk of hurricanes, fires, floods, and droughts.
Yeah, I mean,
think about where those areas are.
yeah. That's very interesting. I guess this the whole Wall Street of the South thing in West Palm Beach, I guess that's part of that too, right?
Yep.
People are flocking to Florida, and hurricanes are all over and plentiful in Florida. It's like,
Yeah. What was this? So Wall Street South builds its own New York to lure the younger crowd. So like Goldman and a bunch of other people are moving to Miami and West Palm Beach. And yeah, I mean, this is, I think in the short term, this works, right? But obviously as the water rises, this is going to become more of an issue. But yeah, I don't know. I just, my thesis is I want to buy as much land in these areas with water that are protected against natural disasters and droughts, because I think over the next decade or two, those are going to become the highest demand areas.
I kind of agree. I think, yeah, there's been this rush into places like Florida or Arizona because they're like southern states that have seen a lot of growth, and they're warm and they have, you know, different politics and things like that.
and
But
Central AC.
yeah. But people have not, I think, taken into account the risks that you're talking about yet, which are only now just beginning to be understood. And frankly, we don't really even know now today what things are going to look like in 10 or 20 years if, you know, some of these climate models that have been put out there, if they're halfway correct, things could get scary in some of those areas, right?
Yeah.
And I think you're right. I don't think people have taken into account climate as a variable in their previous housing decisions. I think maybe just now we're at the very beginning of that happening.
Yep. So if anybody's looking to buy land, my non-financial advice would be to look at areas that are underappreciated today, but could have a gold rush over the next decade.
Yes.
Yeah. I mean, seeing what's happening in South Lake Tahoe is heartbreaking.
Yeah, they just
I was
evacuated,
just
I think.
there a few months ago. It's beautiful. And to imagine it on fire is like, what?
Yeah. I mean, it's becoming more frequent. The drought issues are becoming worse. Fires are up. You know, hurricanes aren't getting better. You know, where can you go or where can you buy land that's kind of protected from those major risks?
It is tricky because there's not a whole lot of places that are immune to every type of natural disaster. Like even here in Texas, we had that freeze out of nowhere in February where, you know, there was a foot of snow on the ground, whereas like it rarely ever snowed, you know, for the last 50 to 100 years here.
Yeah, that was wild.
And then we get dumped on like we're living in the mountains.
Yep.
You know, and the grid, you know, locks up, right? So it's like, I mean, some of this stuff is a little hard to foresee when the weather patterns are changing so much. But, you know, there are areas that are clearly more risky than others. Like if you're in the southern tip of Miami,
Yeah.
if sea levels rise, it's pretty clear you're at risk there of some serious flooding issues.
Absolutely. Yeah. Where are you guys bullish on? I'm kind of curious if anybody's been buying land or real estate or internationally or in the U.S. I'm kind of curious. Feel free to throw it in there. I know for me, I want to be where there's water, right?
Yeah.
And where, you know, you're going to be protective. What are the major things? Sea level rise, fire, drought, hurricanes. Those are kind of the major ones. And I guess earthquakes, right? We don't have a terrible problem with that here in the
Screw
US.
earthquakes. I don't want to be anywhere where there's an earthquake ever.
Yeah.
Yeah, that's
So
terrifying.
if you can avoid those things and you assume that people are going to move to those areas in mass over the next couple of decades, I don't know. I think it's going to be a good play. Like, I know I could either park it in dollars or in land, right? Or obviously Bitcoin, but, you know, I'm fully allocated there pretty much. So, all right, let's keep going, guys. So we've talked about a little bit of real estate. We've talked about, obviously, the crypto markets and the stock market. Nick, I know. Oh, go ahead, Trev.
Oh, I was gonna say, I just was thinking we'll have to focus some time on real estate specifically a little harder, just because and maybe we've talked about this before, but I keep seeing viral tweets from people that are so misguided when it comes to the returns of real estate. One of our buddies, Sam, was tweeting last week, got like several thousand likes about how investing in a home was like a terrible investment historically. And I'm like, no, the data actually shows the exact opposite of what you're saying. And yeah, like it can be a hassle and you can lose money investing in primary home real estate, but the actual data looking over 100 years or more shows that real estate's actually a pretty damn good investment, especially when you look at the levered returns.
Yeah.
But I keep seeing this argument online between like people saying like real estate's an amazing investment versus real estate's a terrible investment. You should only buy it for, emotional reasons, not for financial reasons. And I'm like, man, there's a lot of like misunderstanding about how you judge the returns of real estate.
Yeah. Well, I think people also need to realize like your primary residence is a cost that can be offset by appreciation, but like you shouldn't assume that the appreciation is going to offset your cost. Like basically the way I think about it on average in the US is your cost to live, your cost to own a home is probably today about 5 to 6% of the home's value a year. If you take into even leverage returns, like if you take into consideration a 2 or 3% interest rate on a mortgage, if you take into consideration property taxes, maintenance, those types of things that you wouldn't have if you rented, those in aggregate usually add up to about 5 or 6% a year. So that is a true cost. But if real estate goes up at historical averages, you could actually save a big percentage of that. You're probably not going to outpace that, but you could, offset a lot of the cost. So yeah, I think there's arguments on both extremes, but when you actually look at the data, it does make sense to own it, but it doesn't make sense to over leverage and to ignore the true cost of owning a home. Cause I think a lot of people kind of underestimate how expensive it is to actually own a home. And then they get in and they bought what they could qualify for, which was squeezing every penny out of their budget that they could, and then they're house rich and cash poor. That's not a good situation to be in.
Those are great points. And I think maybe that's ultimately what Sam was trying to get at, was that people underestimate the operating and maintenance costs when they're initially buying a home. And it is regional, and you can overpay for homes like we saw in the housing bubble of 2008, right? Or in certain regions like San Francisco right now, or maybe even Austin. I don't know, at some level, right? When prices get out of whack with like underlying fundamentals like average incomes and things like that, right? So yes, I think the point he was trying to make was maybe that people underestimate ongoing costs of a home, and so the returns don't look as good when you actually estimate the right cost there. And then also you can't overpay and you can't lose money.
Yep.
But in aggregate, on average, I think most people who have bought real estate in the U.S. have done pretty well over a long enough time frame.
Yeah.
In most areas, not every area, but.
And also, hasn't over many decades, real estate has kept up with or slightly outpaced inflation?
Yeah,
on
real estate's
average.
been one of the asset classes as a whole that's beat inflation by a pretty reasonable margin. So.
Yep. We've got some people saying Patagonia, Argentina, buying some land there.
Can you buy land in Patagonia?
I guess if you're an Argentine citizen.
I want to visit
San Antonio, Canada. Hey, there's John Fedro. Mobile homes to the moon. Yeah, so John's the mobile home king. Shout out. All right, let's talk about travel a little bit. Forever changed. CEOs are dooming business travel, maybe for good. So a survey of 45 large companies in the US, Europe, and Asia show that 84% plan to spend less on travel post-pandemic. I don't think this is a surprise. I mean, call it almost 85, 90% of businesses saying that they're going to spend less on travel. That's going to have a material impact on the airline industry.
Does this mean that we're going to get first class and business class tickets cheaper?
Ooh.
I think it might be more expensive.
You think?
Yeah.
Where's the demand? Not many people can afford it.
Right.
And if 84% of companies plan to spend less on travel, on business travel, or whatever the stat was, then like who's buying the business class and first class tickets?
No, that's a good point. I don't know. There's a couple of ways this could go. I mean, that's where airlines make their money. They don't make it on economy. They make it on the premium seating. That's their margin. So are they going to just give that up? Or are they going to try to incentivize? I don't know.
I just had this like nightmare vision where we're all flying Ryanair all the time.
Oh God. I mean, we've already seen like true international first class starting to go away.
Yeah.
Like it's usually premium economy and business now is where they're making their margin. Like, but like true first class is kind of faded out in a lot of airlines. And I mean, Allegiant and Spirit and a lot of the Ryanairs of the world, they're profitable. You know, it's like you feel like you're a damn cattle going to the slaughter, but
I hate flying Spirit and Frontier.
The
and
budget
Allegiant.
airlines are
I can't
terrible.
do it. It's just such a bad experience
Yeah.
for me. I don't know.
That's something that I think is well worth the premium is flying business.
Or
Every
Delta.
time.
Fly Delta.
Yeah, over a certain length or time, I guess, if it's like a more than like 3 or 4 hour flight, it's like it's tough to fly those like bare bones airlines.
Yeah.
That's
Yeah.
for sure.
I guess if it's a quick trip, that's one thing. But like, yeah,
Yeah.
Yep.
couple hours.
Yeah, that's brutal. But yeah, I think it's funny because these discussions about corporate travel, it's always framed as either it's coming back all the way and it's going to recover fully, or it's totally gone and it's dead. And it's like, of course, there's a continuum there, and it's like it's going to be just like work in the office. It's going to be a hybrid thing. Like some companies are still going to want their employees to travel. They're still going to pay for it. It'll just be less.
Yeah.
It might be less for a few years than it used to be, and eventually the economy will grow enough where it'll probably eventually eclipse the previous levels, but for a while it'll be less. It won't go to zero.
No,
Yeah.
I
like-
don't think so. No.
Like I doubt, but your point about the airlines, possibly changing plane configurations, that could happen.
Pricing.
Yeah, and pricing,
Yeah.
that could happen.
I mean, they're already trying to nickel and dime and, squeeze you for baggage and premium seats and,
Yep.
so I don't know. All right, let's talk about employment and COVID data. We'll do this quickly and then get to some Q&A.
Yeah, really quickly, because Travis and I were like debating this. Remember when
Oh,
we were
yeah.
in Colorado? If states that cut off unemployment benefits early, if they saw more job growth or not,
Yeah.
based on that. Turns out it didn't really make much of a difference.
So people are like, I don't care if you're not going to pay
So-
me anymore. I'm just going to not work.
Yeah, so I think that there's obviously a deeper issue here. It could be a mix of people just completely changing their career paths after COVID and doing different things, or doing freelancing or starting their own business or something, and the boomers retiring, or the ones that were kind of forced into retirement due to COVID earlier than they expected. That could have a big part of it too, because
True.
a lot of them are out of the workforce now. So I don't know, but Travis and I were debating this, and you had sent me some data that showed that it really didn't make a difference after I had pulled some data, and sure enough, here we are.
Yeah,
So-
there was conflicting data out there. It may also be the case that like it could be depending on the time frame we're looking at, because April to July is not like that long of a period. And so there may be a lag too. Like it could take a year before we really have good enough data to tell if it is true or not, if cutting unemployment benefits early
Yeah.
made a difference in the overall unemployment rate.
Because the data that I pulled showed that the bottom, I think it was the states with the highest unemployment rates hadn't cut the benefit. So states that hadn't cut the benefit saw really the highest unemployment rates out of all the states. So to me, I was trying to piece that together, and obviously it was, incomplete data. It was just an unemployment rates, and that was it.
Yeah.
But I was like, oh, okay, so there's something there? No. But I guess this is more focused on job growth, and
Yeah, it's like overall. Do you look at overall rates, or do you look at rates of change?
Yeah.
Like over what time period? That's kind of what I was just getting at. Is like we have seen conflicting data on this, so I don't know if we have a full conclusion yet. But this Wall Street Journal article is suggesting that there's somewhat limited impact from the unemployment benefits going away, because a lot of states are saying like, well, we need to get people back to work. We need to incentivize people to get back to work and fill there's a ton of open jobs out there. There's a shortage of workers in a lot of areas. And so a lot of people were thinking, well, if we let these unemployment benefits expire, then people will come back to work. And the Wall Street Journal data is saying, well, maybe not. Maybe we structurally lost a lot of workers, like the people who retired early or people who became online creators.
Or influencers on Instagram or
Yeah.
TikTok.
OnlyFans.
OnlyFans, yeah.
Yep.
All of that.
But it's hard to say.
So we'll revisit this.
Yeah, we'll revisit. I mean, just kind of looking at, the unemployment rate and then the new claims, like there's really nothing new that we've seen over the past couple of weeks. It's just kind of slowly ticking down. I want to show you a head and shoulders pattern that I hope is a real head and shoulders pattern. Look at the daily new cases globally for COVID. If we throw the old 7-day
There it
moving
is.
average on it, I'm really hoping that's
a right shoulder.
right. I hope this is the biggest head and shoulders pattern in the world right now. And if so, that would be really good. What was this? COVID hospital admissions fall for the first time since June in the U.S.
Wow.
I know, cases have been going crazy, but deaths have been way down prior to the prior spike, like we've talked about. So at least in the U.S., it looks like we could potentially be rolling over here, and that would correlate with the global right shoulder. How do we short COVID numbers?
Long travel stocks.
There you go.
YOLO into some stocks. Yeah, probably.
All right, so let's see. Delta's expensive. How's Allegiant doing? I haven't looked at. Oh, there we go. Gotta go. Allegiant, ALGT. There we go. Wow. So Allegiant actually made a new all-time high this year too. So the budget airlines are expensive.
Yeah, they're more U.S., so I think that the more domestic airlines have done better than, say, Delta or American Airlines or United. 'Cause they
True.
have a lot of global exposure.
Yeah.
That, we're not. But look at us. Like, we would have already been traveling overseas by now.
Oh yeah.
Many times.
Yep.
So those are plane tickets lost by the big airlines.
Good point. Yeah, they definitely need our revenue to increase.
No, you know what
earnings.
I'm saying? Like, there's a lot of people that want to do international travel that haven't. So a lot of, there's going to be a lot of opportunity for those airlines they're going to be busy.
Yeah.
When things open up globally.
It was such a tease because there was all this pent up demand, and then like Delta hit right during the summer, and so I know a lot of people canceled plans, and so maybe that demand is just like a pressure cooker that after this wave, after that right shoulder breaks down, there's going to be an explosion of
I
movement,
think
and then
so.
a fourth wave. No,
No, I
knock on
think
wood.
there's going to be an explosion of international travel. I think these countries aren't going to know what hit them
Yeah.
when the tourists start rolling in.
Hell yeah.
Especially the Asian countries.
Yeah, they've been largely shut.
Yeah. And they need the tourism.
Yeah, Indonesia's numbers have come way down, which is a good sign. I know we want to do an event in Bali one of these times. Let's see, Indonesia, they're down quite a bit. Yeah, they peaked out at 50,000 cases a day, and now they're at like 10,000 a day.
That's
Good for Bali.
Yeah, that's encouraging.
Yeah, man.
Love to see it.
All right. Well, let's do some Q&A. What questions do you guys have? Feel free to throw them in chat there if you're watching live. Nikki, I think we had a couple that were submitted, right?
Yeah, we did. We had a couple that were submitted. Darren asks, how do you manage multiple stock and crypto portfolios? Should you just focus on managing one active portfolio or not?
So the way that I look at it is I have multiple capital buckets, right? So like I have my overall portfolio, and then I have my cold storage, which is like my never touch crypto, my multi-year position trades, my short-term capital, and then obviously like passive and active stock market capital, but it's all the same portfolio. It's just like different capital buckets and strategies. I don't know. How would you guys say that for you?
I think It may depend on how much time and bandwidth you have to devote to your active investing pursuits, because if you want to do crypto and stocks, that's a lot.
Yeah.
Even within one of those asset classes, you could spend all your time and still not have enough time. So I think it's difficult if you want to be a super in the weeds active investor in both asset classes, but
That's a full-time job.
yeah. I mean, we do it in our community to some extent. I mean, we do and we don't, right? Because you guys handle the crypto side and we handle the stock side. So we have our own
I
specialties.
don't know what the hell's going on in crypto. Like, I can't keep
But,
up with all of it.
Yeah, I mean, I think for me personally, for instance, I do a more passive crypto approach while doing an active stocks approach.
Yeah.
So maybe that is kind of a sweet spot for those, who are able to do that. Or maybe it's an active crypto with more of a passive stocks.
Yep.
Or maybe you do try to split your time a little bit in crypto and a little bit in stocks. But someone who's going to have a lot more time will be able to do that. Whereas if you have a limited amount of time and you want to be active, you probably want to specialize in one area.
Good point.
Yep. Perfect answer.
Yeah, I think so. And maybe start with one thing. Like if you try to jump into both and you try to do all the things all the time, like you're going to be very overwhelmed. Maybe if you have, no job and you just have a lot of capital and you want to manage your own portfolio, great. But I know a lot of people are still generating an income some way and trying to manage their portfolio. So you don't want to get overloaded, but maybe start with like, how much time do you have? How much capital do you have? And where do you want to dedicate your time?
I will say one other thing, which is the crypto and stock markets do sometimes go negatively correlated, and sometimes one of those markets is quieter while the other is popping off. And so, if you are interested in both crypto and stocks, and say you're part of our community, for instance, there are times where I know some of our members focus more on crypto when it's popping off. And then when the crypto markets go quiet or go into a bear market, then they come over to the stock side and spend more time to try to find returns on the stock side. So
yeah. And if both are slow, there's
Go on a
angel
vacation.
investing, there's vacation. No, there's other ways that we invest and generate returns when just the charts are slow. So there's other ways to build wealth too.
true.
Cool.
We did get one more.
Yep.
So this is from Jenna. She says, I'm relatively new to the crypto scene and I want to learn more. I've been thinking about joining the Skill Incubator community, but I'm not entirely sure if it's a fit. Basically, can she get an idea of what the community is about, and if the content and fee makes sense for her at her current stage of learning?
Why don't you answer that one, Jenna?
So for crypto, I mean, well, first of all, what the community is basically myself, Travis, Chris, and Rocky were the mentors in the community, and we offer not only a Discord channel where you can, communicate with members that are in both crypto and stocks, but we also do market updates every week for crypto and stocks as well. And even if you're a beginner, there are actually extra resources in there for you on the crypto and the stock side. So, and you're able to ask a lot of questions in the updates. So I would not feel, if you're a beginner, that it's too advanced for you at all. We have people that are brand new coming into the community, and I think the resources in there are really helpful no matter what stage you're at.
Yeah.
Now, as far as the crypto specific resources, you can speak a little bit better about that stuff.
Yeah. I mean, essentially the community is meant to help people digest all the information that's coming in like a fire hose every day and be able to find the noise and the signal and filter the noise and then focus on where the best returns could be, right? And also learn and like build a foundation, get your mental game right, understand how to look at fundamentals, technicals, all that stuff, and then just have a community, because investing and trading is a very lonely game.
Yeah.
And if you're doing it by yourself, you're going to be limited by your own perceptions of things.
Yeah.
So it's very helpful to hear from other people that have done very well, or other people that are new that have the same questions as you. So, yeah.
Yeah, we've got so many amazing crypto community members that are so helpful with newbies. I see it all the time. I mean, people go in there and ask questions, and people, multiple people jump at the opportunity to help somebody and help them learn the right way to do it. So I think that it's a really good environment for people that are new and maybe feel a little bit apprehensive about, asking questions.
Yeah, that's a great point. So yeah, we've got it linked up in the description. If you guys have any questions, you can always reach out to us. I've got a question from Anono. Do you guys really think you can beat a 0.1% low cost, 100% stock index fund over the long term? Warren Buffett says he thinks he met a few in his lifetime that can beat the S&P on a consistent basis. I think that's a great question, and it's a fair question, because there's a lot of data that shows that a lot of active investors, there's a lot of data that shows that day traders, almost all of them in today's market, lose money. But there's also data that shows a lot of active investors and medium time frame traders underperform just buying a low fee index fund. Travis, why don't you take this one? Since you have worked at kind of the highest level of the hedge fund game, and you've seen big money people that have over and underperformed the stock market.
I love this question. It's the right question that someone should ask if they're thinking about taking on a financial advisor that's going to manage their money, or if they're managing their own money actively. It's like, do you think you can beat the passive indexes? It's a lot harder than it actually sounds.
Yeah.
There's like 80-90% of all mutual funds and hedge funds that underperform the index, and these are professionals. And so the question is, how can you as a non-professional even think you could possibly outperform the indexes over a long enough time frame, right? You might be able to outperform for 6 months or 12 months, but can you do it over a 10, 20, 30-year time frame?
Yep.
And personally, I think yes, I can. So far, so good. I have over the last decade. I have a pretty good track record. But there are a lot of people who won't be able to do that. However, I think the statistics are a little bit misleading, because when you look at a lot of the institutional funds, like mutual funds and hedge funds, they have a size problem. They get to a certain size, $1 billion plus, $5 billion plus of assets under management, and it does get very difficult for them to outperform because they're so large. They're trying to invest so much capital. There's only so many stocks that they can even invest in. Like, take, for instance, just the U.S. market. There's about 4,000 publicly traded U.S. stocks that are actually on a listed exchange. Now, when you look at a $10 billion or even a $5 billion hedge fund, they might only be able to invest in about 600 or 700 of those stocks. So their universe of potential investment opportunities is significantly smaller than yours as an individual investor. So while I do think, most people who don't have the time to spend on learning active investing and spending time doing research like I do probably can't outperform, I do think there is a decent size of population of investors out there that can outperform if they're willing to put in enough time and enough effort, because they do actually have some advantages over these large institutions. Other things like mutual funds, for instance. Mutual funds over-diversify. If you look at the portfolios of ETFs and mutual funds, they hold hundreds of stocks at a time. If you're willing to go a little bit more concentrated, say own 5 or 10 or 20 positions as opposed to 100 or 200 positions at a time, statistically you are more likely to have the opportunity to outperform, right? So that's another aspect to this whole thing. So I guess to answer the question is, do I personally think I can beat the S&P over a long enough time frame? Yes. Have I done it over the past decade? By a large margin. And I think I can continue to do that for the next 10 or 20 years. But,
hell yeah.
Yeah. But I'm also not your average person who only spends an hour a week looking at the Wall Street Journal, right?
Yeah. You're a fundamental analyst genius.
Yeah.
So that helps.
Well, thank you. But where I would leave it is, if you're thinking about this question yourself as an individual investor, take a hard look at the amount of time and effort that you have to put into it. If you have 2 hours a month, very unlikely you're going to outperform. If you have 10 hours a month, you might be able to do it, And if you have mentors like us around you to help you, if you have resources that you're tapped into that can give you an edge, then you have that opportunity. So just take a hard look and be realistic about whether or not you have the conditions in your life to be able to outperform.
And I also think, by the way, great answer. I would add to that adding non-stock index assets to your portfolio can also extremely help you outperform if you find a thing like Bitcoin, right? Or a lot of these altcoins. Like, I know my portfolio has kicked the shit out of the S&P over the past 8 or 10 years because of crypto, right?
Yeah.
So when you look for new opportunity and when you get into high growth assets and you don't get rug pulled and you don't make the mistakes that we talked about in the first half of this show, that's how you can outperform the SPY or, ITOT or one of these low fee index funds, right?
Yeah.
You introduce other asset classes like angel investing, right? A lot of angel investors lose money, but we know people that have made great returns. My returns are not amazing, but I'm net positive, so does luck play a factor? Yes. Does timing play a factor? Yes. You've got to find non-correlated assets, and I think that's where you can also add alpha above the SPY.
I'm so glad you said that, because portfolio construction is something that people don't think a lot about, but can have a massive difference in how your portfolio performs over a long enough time period. So yeah, making the right sized bets with your portfolio, so not being too concentrated, but not being too over diversified, like I just talked about with mutual funds, having non-correlated assets in the portfolio, because I was earlier just speaking to stocks specifically,
right? Yeah.
But you kind of broaden it to the portfolio level. So I'll just say quickly on that, like we go through a lot of portfolio management stuff in our community, because it turns out when you look at like the numbers, you can create a portfolio that grows at a really nice rate without massive drawdowns just by allocating to the right asset classes from like a top down level, not even picking the right stocks or cryptos, just allocating to a few different asset classes that are less correlated with one another can actually help you outperform, like, let's say, just a stock index fund over time. And then there's all kinds of other things you can do to enhance the portfolio as well. There's even like strategies, like you could read books like quantitative value or quantitative momentum. And these are like formulas that people have used to actually outperform the indexes just by eliminating certain stocks or adding certain stocks with certain qualities. So there's, while it seems really hard to outperform, there's some basic things you can do to set yourself up for like high probability of outperforming.
Yeah. And then in addition, just to looking at like, okay, what's my return on this asset? That's where Nikki comes in. She puts her CFP hat on. As a financial planner, you can strategize and minimize the most expensive expense that we have in our lives, which is
taxes.
Hey, taxes, right? So you can strategize taxes. You can strategize all different. There's what, like 6 pillars of like your overall financial plan. And when you do that, that can also juice your returns and save you a ton of money. So it's not just what is my net return on stocks at the end of the year. It's a whole thing.
Yeah, exactly.
One last thing I want to make sure I mention is that it is likely that you will have drawdowns if you are, more concentrated in trying to outperform the S&P. Even if you've allocated your portfolio with non-correlated assets, like there are times where it's still very likely if you are fairly concentrated that you're going to have drawdowns, and you just have to be mentally prepared for that and know that you might underperform the indexes actually some of the time, even if you outperform over a longer time frame. So I know I've seen that in my portfolio. Last year and early this year were phenomenal. It was massively outperforming. And then in the last, probably 3 to 6 months, kind of hit a wall and have started to underperform a little bit. And, there's various reasons for that, but fairly confident that, I'll get through that period and compound well above the S&P again. But
yeah, it's the long game, right? It's like you don't want to judge your performance on any random month or year even. It's what is your multi-decade track record.
Yeah, exactly.
Awesome. Trav, what sources do you recommend so we can learn how to read fundamentals?
That's a great question. So I have a course that I created, like a stock investing bootcamp course that's about 30 to 35 hours of content. I teach it live 1 to 2 times a year. I'll probably teach another one late this year. I built that because I thought there wasn't like a perfect reference, whether it's a book or course or whatever out there that teaches like fundamentals. But there are some resources I can point you to out if you don't want to take the course with me. There's some books like, books like I would say One Up on Wall Street or 100 Baggers or even more wonky corporate finance stuff. Like there's a book I recommend people if they want to kind of get into the math of like corporate finance and valuation work. There's a book that I recommend to people, and I'm all of a sudden drawing a blank. It's
probably some.
It's a boring title. It is called. It's like a little blue book, and now I'm all of a sudden drawing a blank. But
you did a YouTube video about that, right? Your top books.
That's right.
Guys, check it out. Stock Geek TV. One of these years, Trav will start doing YouTube videos again. He actually did a video talking about your favorite books, right? And where to get started. So
those would be a few that I point you to as a starter. Other than that, obviously you could take university finance courses that teach things like valuation. Michael Mobison's work is pretty good, but a lot of it gets into the hard part with a lot of that stuff is it gets into a lot of very technical, very academic underpinnings of valuation and theory. And you really want to have the grounding in the theory, but also like how does that apply to actual real stock market movements? And that's kind of what I tried to do with my course was like, okay, here I'll give you the theory of what valuation is. Here's the theory behind a DCF. Here's the theory behind a PE multiple. How do you actually go and apply it?
Yeah.
And that's where I think there's a big gap in the market. Analysis for Financial Management. That was the book I was trying to
God, that sounds like the most boring book in the history of humanity.
It's probably some title that's like super academic.
Wait, say it again. I already forgot it.
It's called Analysis for Financial Management by Higgins.
Okay.
And it's thinner than a textbook, and it actually has a pretty good practical treatment of like things like valuation theory without being like too dense.
Dry.
Yeah. But it is more on the theory side, right? So that's a good book if you want to go get the theory part. And then if you want to go like think about the applications of that theory, read a book like One Up on Wall Street by Peter Lynch, which is more of like applying it. Read a book like 100 Baggers by Chris Mayer. Or come take my course where I'll actually walk through lots of examples of real world stocks and how we apply the theory to the real world, and even how we look at sources out there today to find stock ideas and things like that. So,
Is there's a fundamental analysis primer for community members, correct?
There's a free course in the community that goes through a lot of that theory as well.
Yeah. It's kind of like the beginner stuff, and then your boot camp gets into the weeds.
Yeah. Awesome. Penny was asking, do you guys think that interest rates are going to stay low for quite a while?
Yes.
This is the $1 trillion question.
Yes.
Yeah.
I think so. Maybe not zero or close to zero, but low.
Yeah, we talked a lot about inflation earlier this year in the show, and I still think inflation is going to run hot above targets in the kind of medium term. We're in this weird delta period where some of the economic data is rolling over, and it doesn't look like the inflation data is starting to roll over. But I actually am still I still think in the medium term inflation is probably going to surprise to the upside because of all these structural issues we have in the supply chain and the labor markets and things like that. But that means that brings about the question: what is going to happen to interest rates? Because on the one hand, if you get inflation starting to print above the Fed's target, they need to raise rates to deal with that. On the other hand, can you raise rates in a world with all this debt? And a lot of people will tell you they don't think it can happen. Rates can't go above, say, 2 or 3% just for the fact that like the government, it starts to crowd out the government budget, starts to create pressure on households because of higher mortgage rates and things like that. And I'm kind of sympathetic to that view too. So I think what could happen is we could get a situation where if inflation is printing above targets, they're gonna try to raise rates, but they're gonna have a hard time doing it above a certain level because it's just gonna crush the economy. So we're gonna have this like push and pull, I think, between inflation running hot, they need to raise rates, they raise rates a little bit, economy slows down, they got to drop rates. I don't think we're ever going back, at least in our lifetimes, to like 5 or 10% interest rates.
No,
But-
that would be a dream. 5%.
Yeah.
I can earn 5% to save my money. That'd be awesome.
Well, so I think what you're saying in a nutshell, though, is buy Bitcoin.
I think
Or
yeah.
yield farm.
Yeah.
Yeah.
That's my, yeah. I mean, it's funny, you know, I joke, but I'm not joking about that. It's like when you look at the ammo that the Fed has and the options that are out there, it's kind of like, yeah, I guess it does make sense to have a lot of Bitcoin. I don't know. That's the conclusion I've come to. So
Yeah. I mean, I think rates are too low today, but I don't think structurally they can go that high, just given where like global debt is.
The Fed is backed into a corner.
Yep.
All right. Well, we've been going for over an hour and a half, so we can go ahead and start to wrap it up there. I guess in conclusion, talking about our favorite wealth building strategies, why don't we do like a 2-minute like wrap up summary? So I think it kind of starts again with this idea that you've got to survive and then thrive, right? Like whatever you do, start with the idea of not permanently losing capital. Don't get rug pulled. Don't put all your money into a high risk thing, because if that thing fails, even if it's a 10% chance that it fails, you're out of the game. Done. Who cares if you quadruple your money if you're going to lose it all in 6 months? From there, begin to hunt for high conviction trades where there's asymmetric risk to reward, right? You see a lot of upside, you can limit your downside, and you can size it properly.
Or invest in the broad market and in ETFs.
Or don't be tactical. Don't do what we do, right?
You don't have to do what we do.
Yeah.
That's always an option to invest passively.
Yeah. Yeah, I mean, 2/3 of
still
your
get
portfolio are
rich
still
slowly.
passive.
Yeah, I'm
But your active has outperformed your passive
my
in recent
active
years.
has added some serious alpha
Yeah.
to my portfolio. And actually, I pulled up I did a model portfolio in Y charts that actually had S&P 500 index fund with a few up to 10% of positions, individual stocks of Apple, Amazon, Facebook, like up to 10%, just a few small positions.
Yeah.
And it had over a 10-year period beat the S&P 500 index by 67% over that 10-year period. So it added 67% basically over that period. So you can incorporate this strategy of passive and active together in a way that makes sense for you and adds alpha.
Yeah. Trav?
Yeah, I think building wealth is about not only protecting it, but growing it. And those things can often be, or they can seem like they're in conflict with one another, right? To some degree they are, but if you think about people who are families that are worth $10 million or more, right? They're not going to go YOLO everything into one stock or one crypto or gold, right? They're going to be diversified into different assets. They're going to take some shots. They may invest in some hedge funds. They may invest in some angel investments or some private equity funds or some deals, some real estate, right? They're going to take their shots. They're going to try to grow their wealth, but they're also going to protect it. And so I just try to model what I do after that, where you're not only trying to play defense, but you're trying to play offense too. So how do you do both? Well, it's like you were just saying when you summarized, it's you don't take yourself out of the game by doing anything stupid. You're YOLOing 100% into some high risk asset, right? Take shots, but don't do it with all of your capital all at once.
Yep.
And think about finding investments where the risk reward is tilted in your favor. So it's not like a 1-to-1. Oh, I'm going to bet on black or red. No. Find something where you can make 5x in an upside scenario, or if the downside scenario plays out, you lose a little or you lose nothing.
Yeah.
Try to find those types of scenarios. And then, of course, like we talked about with your portfolio construction, try to be thoughtful about adding assets that may be less correlated to one another, so that if some certain thing happens in the economy, not all of your assets go down at once. Not all of your assets are going up at the same exact rate at the same exact time. Those kinds of things can go a long way in building that smooth wealth building curve over time.
Great advice.
And
Yep.
learn how to strategize your taxes.
That
Yes.
too, yes.
Please. For
Yeah.
the love of tax.
Yeah.
For the hate of paying taxes, learn.
how
Yeah.
to calculate your taxes so that you know how to save on them and strategize on them.
Yeah.
I mean,
So
again,
important.
Get a good CPA or
Get a good
CFP
CPA.
or somebody to help you with that.
Yeah, or
there's a
yes.
reason that ultra wealthy people and corporations employ tax professionals. It's
Yeah.
so they can minimize their taxes.
Yeah.
Yep.
One more thing I'll say too is if you're not wealthy yet and you have a wealth goal in mind, maybe it's 1 million, 10 million, 100 million, whatever it is, act as if you have that capital today. Meaning what you do with your routine, your behavior, like in the markets and your research and your process, act as if you have that capital already. Meaning how this applies to Bitcoin, say you have $100 worth of Bitcoin or something. Act as if that's worth 100 million. Keep it safe. Learn security. Have hardware wallet. Don't use SMS 2FA. Like, do all of those things while you're small. That way you don't fuck up when you're big and lose millions of dollars. I've talked to several people that have lost many, many millions because they were reckless or careless or just grew too fast, and they either made bad investment or trade decisions, or they lost it because they got scammed or hacked or something. So don't do that. Like, again, I put that in the category of avoid permanent loss. Act as if you're already to where you want to be, and that'll help you mentally too from chasing shit and getting overly aggressive.
Well said.
And on that note, let's go get drunk. Oh, I saw some people laughing about that. Okay, cool. Anything else you guys
Did I
want to talk
miss the
about?
memo on the drunk thing?
I don't know. I think everybody else in chat's drinking. I mean, we got these Waterloos.
Oh, I see. Okay.
Oh, let's go get some of that duck horn, huh?
Hey, a
Ooh.
little bit of vino. Got to celebrate. What are we celebrating? We're celebrating Ethereum's breakout today.
Hey.
Nice little pop. Looks
Yeah,
like
that
we're going
looks-
for all-time
that
highs.
looks
That's a good looking chart.
Pretty bullish.
That's a
Yep.
good looking chart.
That's the thing. Like, you know, looking back, it was like at this time when I took profit at 4,100 right there, it looked parabolic, but you don't know. You never know into the future. Is this parabolic move going to be the top, or is there something in several months coming, right? Like, never underestimate what crypto can do. Yeah.
Brad, thank you for the comment. That's very kind.
Yeah, appreciate you guys. Thanks for
Yeah.
watching. Go to wetalkmoney.com to submit a question for the show. You can subscribe on podcast. Thanks to Y Charts for sponsoring the show. I don't think I said that in the beginning. What else?
If you're interested in joining the community, I know we talked about it briefly today, but
wetalkmoney.com/community.
yes.
Yep. Yeah. Check it out.
Yeah. Hopefully one of these days we're going to be able to do a live event again.
Oh, I'm waiting.
Yeah. We've done Cayman, Amsterdam, Austin. Yeah.
Gotta wait for that third wave to get crushed.
Yeah, that right shoulder.
Yes.
We gotta do Miami before it gets flooded underwater.
That's right. Yeah.
All right. Well, guys, thanks for joining us, and we'll see you next time.
See ya.
Take care.